The rules of this strategy are quite simple. First of all, you have to pick a continuity pair. And a continuity pair are pairs that usually follow the same trend a day after, maybe 2 days after or 3 days after. For example, the best example I will give is the Euro USD. The Euro USD, there is a 80% chance that if today is bullish, tomorrow will be bullish, or if today is bearish, tomorrow will be bearish. And that's what I mean by the continuity pair. So you first of all have to look for a pair that is a continuity pair. Now on our chart, we're going to first of all follow the two rules. First of all, look for a continuity pair. And for the best pair for this day trading strategy is the Euro USD pair, because from what you can see on your screen, it is one of the pair that actually follows the previous day trend most of the time. You can see from here, from this bearish candle, we have 8 days of bearish activity. You can see here we have bearish, we have bullish here, and we have bullish here. And you can see from your screen, even from here where the market was a little bit chaotic, you can still see it followed the bearish trend for 3 days, and so on and so forth. Bearish, bullish, bearish. I mean, it does that for like 70% of the time. So this is one of the best pair, and most USD pairs actually are continuity pair, but it varies across. But for this day trading strategy, the Euro USD is one of the best pairs to trade. So we've gotten our continuity pair, and next we're going to move into our 30 minutes time frame. Now for the examples for this day trading strategy, I'm going to give a bullish example and then I'm going to give a bearish example. But before we move on, I just want to give some rules for the second part of this day trading strategy, which is we're going to wait for a breaking market structure. Now, first, if the previous day is bullish, the next day we're looking for a bullish opportunity to go back into the market, and then wait for, how do we look for this bullish opportunity? We wait for the market to reverse. So if today was bullish, then tomorrow we're going to wait for price to reverse back into the previous day price action, and then we're going to wait for a reversal pattern. I think with the example it's going to make so much sense. We're going to pick a bearish example first of all. Okay, I think I traded this. Yeah, so this is an example. So this day, I'm going to put a vertical line to signify. So this day ended bearish. This particular day ended bearish. As you can see, the price started here and it ended here. So and this is where the market ended on the 6th of January. So the first step is that we know in our mind that we're waiting for a bearish opportunity on the 7th of January. Since the 6th of January ended bearish, we're waiting for a bearish opportunity on the 7th of January. But first of all, we have to make sure that price reverses into yesterday's price action. Now, everything that happened here from this top to this line here is yesterday's price action. We have to make sure that price reverses into yesterday's price action, which it did here. Then once it reverses into yesterday's price action, we have to wait for a breaking market structure. And a breaking market structure can happen in so many ways, but for this trading strategy, we are first of all waiting for two strong rejections that is pushing price to the direction of our market, or the direction we're anticipating, in this case bearish. So we're waiting for two price rejection that is pushing markets, that's pushing price to the direction of our market, in this case bearish. And after those two rejection have been printed on the chart, we are then going to wait for a break in structure. And the break in structure can be a lower low being taken out, or being engulfed, or being crossed, or an equal low being crossed, or a point in the market where there are a lot of wicks being gathered. If there's a point where there are a lot of wicks gathered, once price closes below that, then that is our breaking structure. So we're waiting for we're waiting for two major rejections to the direction of our trade, and then we're waiting for a breaking structure. And so these they ended bearish. These they ended bearish. So the next day, which is 7th, we're waiting for price to reverse back into yesterday price action, which it did here. And now we can see on our 30 minutes time frame, take note, we can see the two major rejection. The first one here, this green candle, though is bullish, but we can see that that is a major rejection. We can see a second major rejection which occurred here. We can even see a third major rejection that occurred here, which means that this zone is actually a very pricey zone. A lot of price action is going on here. So after this rejection, where is our breaking structure? Our breaking structure will occur here, because these are equal lows. It's going to occur here, or it's going to occur here, because these are also equal lows and a point in the market where there are a lot of wicks being gathered at. So our breaking structure occurred here. So now what next? You just have to wait for a reverse of price. You just have to wait for price to reverse back up to close the fair value gap that is being opened here. Sometimes market do not close the fair value gap, sometimes it does, but you just wait for market to close the fair value gap, which occurred here. Sometimes, to be honest, I really do not wait for market to close the fair value gap, but surely what I do wait for is for market to go back to the previous low. Now, if you waited for market to break below this particular low, then this is the previous low. Let me signify that. Then this is the previous low. If you waited for market to break here, then this is the previous low. Then this is where I look to take my trade from. I'm going to take my trade up there, here, and I'm going to put my stop loss above this point, or above the entire market. And then I'm going to put my take profit below the lowest of the day. So you can see that's your stop loss will be 12 pips and your take profit will be 17 pips. And even though you look to extend it, even though you would have entered the next day, you would have easily extended it to get like you'd have easily extended it into your stop loss being 12 pip and your take profit being 43, 44 approximately. And then this day also ended bearish. The 7th of January also ended bearish. So the 8th of January, which is a Thursday, we waited for price to also, our rule is that we have to wait for price to reverse into the previous day price action, which it did here. It reversed into the previous day price action. And then we're going to wait for two major rejections. Now we can see there are no major rejections here, just some not less intense rejection, but there is, let me take this out, but you can see that there is a major rejection here. There are a series of small wicks here, but there is a major rejection here. and there is another major rejection here. Now, to be honest, I would have taken this trade because after this major rejection, there were some other small rejections here. But after, I must see at least one major rejection. But say we're sticking to our rules, as you should always do, and you wait for the second rejection. This is one major rejection, and then this is the second major rejection here. Then we'll wait for price to break. After this second rejection, we're going to, and then we can see a third rejection here. We'll wait for price to break structure, and the market structure was broken after this horizontal line, and it was broken with this candlestick. So once it's being broken with this candlestick, as I said, you're going to wait for price to go back up and close the FEG, and then you can then take your trade at the close of the FEG, which will be around here, and then you stop loss here, and then you take profit here. That's a simple 12 pips stop loss and 27 pips take profit. So we're going to look for a buy example, and for our buy example, I'm going to show you one buy example, and this is the 14th. Yeah, this is the 15th of December, Monday, and we can see that this day ended bullish. This day started here and it started from this blue vertical line and ended on this blue vertical line. So the Monday of the 15th of December, Monday, ended bullish. Now I'm going to go over our rules again. The next day, we're waiting for price to reverse into the previous day price action. After it reverses into the previous day price action, then we're waiting for two major rejection candle that is pushing price to the direction of our market. Now in this particular example, bullish, then we wait for a break of structure. Now this is Tuesday 16th, and market reverses into the previous day price action, and we see, let me see if I can get an arrow. We see our first price rejection here. This is a major rejection candle. You can see that there is a weak rejection pushing market to the upside, and then we can see our second major rejection candle. Now this is 1 and this is 2. So after we've seen our second rejection candle, we're going to wait for a break of structure, and our break of structure occurred here. Our break of structure occurred here because, yeah, our second rejection, then there are so many wicks gathered here. You could also say break of structure occurred here if you want to be if you want to trade the market a little bit risky, but just be on the safe side, because you have to make sure that all the wicks are being engulfed. The break of structure happened here. So now we have waited for price to reverse 1. We have waited for 2 rejection candle to the intended side where we want to trade, which is bullish, and then we're waiting for the break of structure which occurred here, and that's your trade. I would have taken this trade once price reversed back to this break of structure, which it did on this candlestick. But as I said earlier on in this video, you can also wait for price to go and close this FEG. I'm going to explain more about FEG in some other video. So if you do not understand it properly with this video, you can check my other videos about FEG. But I could still take this trade at this point of breaking, and that would have still been a very profitable. That would have still been a very profitable trade. And once I take it here, my stop loss is going to be below the candlestick, or below candlesticks that started the FEG. And then if you had taken this trade, that will be 14 pips stop loss to 36 pips take profit. So that's the bullish example of this. Now if you followed me from the start of the example, you might think that the risk to reward is not as juicy as most of these professional traders, so-called professional traders, that show you 1:3, 4, 5, 1:7, 6, or 1:10. But the truth about this strategy is that it's all about consistency. You're going to lose sometimes, you're going to make profits sometimes, but overall you're going to make more profit than loss. As long as you follow your system, you're going to make more profit. And even when I trade this strategy, I use 1:1.5 or max 1:2. I do not exceed 1:2, except I'm feeling really lucky that day, then I use 1:3, 4, or 5. But just be consistent. Keep your risk to reward to 1:2. Use your 30 minutes time frame to spot your reversal, and take note of these rules. Rule 1: if yesterday was bearish, then today we're looking to go bearish. Rule 2: price must reverse back into the previous day. Current day price must reverse back into the previous day. And then rule 3: you must see 2 strong reversal candles that is pushing price to the direction that you want to take that day. That's if you are taking bearish that day, you must see 2 strong 30 minutes rejection candles that is pushing price to go bearish. Then after those rejection candles are printed, then you must wait for a major breaking structure. Now, I hope you understand this video, and if you have any question, please do well to ask me in the comment section. We share insight like this in my Telegram group, which the link is in the description below. And thanks for watching.